the play-in song for the CFOs. Who's in the mood for ship finance? Take it away, Andrew. Show it.
Thanks, Mike. Good afternoon. My name is Andrew Shohet. I'm part of the Ocean Industries team at D&B. On behalf of D&B, I just want to say thanks to Marine Money, Matt, Mike, the whole team. Thank you for putting together another great event. I'm a big fan of the walk-up music. I think it's, for the Americans in the audience, it's for me probably the closest I'll ever get to being a professional baseball player. So really a big fan. Quite excited about this panel. I have a lot to get through. I'm going to do a quick intro, and then I think we're going to dive right in. But we're joined by 5 public company CFOs, Chris Avella from Scorpio, Ted Young from Dorian, Bart Kelleher from Ardmore, Peter Allen from Genco, and Jeff Pribor from Seaways. So to kick it off, I think, over the past few years, you've all, I think it's safe to say, transformed your balance sheets pretty substantially. I'm going to throw this one out, and Chris, maybe I can start with you, and I want to just kind of walk down the line. But could you maybe talk through, with the benefit of hindsight, having paid down quite a bit of debt, how do you think that strategy has played out? And if you can also just quickly touch upon sort of what you've achieved in that respect over the past few years.
Sure. Thanks, Andrew. It's no secret Scorpio's been paying off a lot of debt over the past year, over the past 3 years. I think the strategy has played out fantastically. It's been twofold. It's accretive, right? We've built equity on our balance sheet in an upcycle. So shareholders have been handsomely rewarded for that. You just have to look at the stock price over the last 3 years. And the returns have just been phenomenal. But what I like as a CFO is what it's done to the balance sheet and how it's set us up for the long term. And I think it's the same for everybody up here. Our break-evens are $12,500 a day, and the balance sheet is very low leverage, below 20%. So we've set ourselves up to survive really cyclical lows. 12,500 a day was really the lows we reached in like the depths of COVID. And so it was an important target to hit. And the reduction in debt has just, worked out well for that. So, I think it's been great.
Ted?
Yeah, I don't think anyone ever regrets paying down debt.
Maybe the bankers.
Bankers who now complain that you were complaining to me too that you had a lot of money to lend at an exorbitant rate, by the way. But look, I think like Chris said, we all, people talk about loan to value and debt to total cap and everything else, but I think the folks up here, we all live and die by the cash cost per day, and so. I'm exactly where Chris is. Driving down that cash cost per day, that break even is mission critical, and we've done the same thing. We did, we sort of had our near death experience between 2016 and 2018 when VLGC rates plummeted, and they literally, I went back and I actually looked at our TC per calendar day and our cash cost per calendar day, and I knew we'd burned a lot of cash, but I actually calculated how much. I won't tell you, but I mean, we made less than $20,000 per calendar day, which was really, really low. We took, we didn't have much of a choice, but during that time period, we refinanced a lot, termed out a lot, mostly in the Japanese, pretty much exclusively in the Japanese market, did exactly what we wanted. And then when the cycle turned, we were well positioned, generated a lot of cash. We haven't really done much in the way of prepayments, a little bit, but mostly, we've got, we amortize about $54 million of debt a year, which is kind of roughly. Am I boring you, Jeff?
I dropped the mic.
Yeah,
you are.
You warned me that I might bore you. So, and Andrew had a bet about who was going to be more boring, you or me. So, we'll take a poll at the end. But at any rate, so happily.
You're off to a good start.
Oh, you're just warming up. I can see. Oh, this will be good. You are known for your witty repartee. Any rate, so we, we're happy with where we sit. We managed to pay a bunch of dividends in the interim, and rates have been off, no secret, and we think we're well set up.
I think we'll keep it moving. I appreciate that.
I'd love to jump in, though. Can I jump in?
Yeah, please do.
No,
Please do.
no. Cases matters closed.
And again, rather than repeat what these gentlemen are saying, and it's right. I mean, we've been doing the same stuff, and it's been great, and I love where we are. But I would say this: the point of delevering is to be able to relever, right? The reason that, and I'm sure it's true of my colleagues here too. Yeah, it's good to have low break-ins now, but when the opportunity is there, I mean, we can do a $500 million deal tomorrow. I mean, literally tomorrow with undrawn revolver. And we can do a $1 billion deal in a few weeks, and I won't be afraid of where my leverage is, having done a $1 billion cash deal. That's the beauty of deleveraging. So it's some of the stuff that Chris and Ted were saying, and I was teasing them, sorry, but I'm sure all of us feel it gives us a lot of opportunity to act when the time is right.
I think dividends, returning capital shareholders. That's a big theme. Clearly, together with the liquidity, which is something we're going to get to. Peter, you guys of course have a pretty tested strategy when it comes to that. How do you think about your sort of priorities when it comes to prioritizing deploying your capital, whether it's further reducing debt to reduce break-evens, investing in the fleet, returning capital to shareholders? How do you think about that?
Yeah, I think it's a holistic strategy. At Genco, we've paid down about 80% of our debt over the last 3 years. We've also paid out $220 million in dividends and invested about $300 million in our fleet over that period of time. So it's a three-pronged approach in terms of our capital allocation strategy. But it is important to balance all of that. Being delevered, to Jeff's point, you have the ability to relever with the cycle. When we delever, we also don't lose the ability to borrow. We still have a $330 million undrawn revolver availability, so we can relever when there's opportunities, and we have done that opportunistically over the last few years. So it is a holistic approach to capital allocation.
Bart?
Yeah, I think similar. Ours is a four-pronged approach, and when we think about the maintaining our fleet, that actually also includes making significant energy transition investments and really driving down your fuel consumption and emissions at the same time, and directly aligning with profitability. So balancing that with delevering, with returning capital to shareholders, and then at the same time always looking for potential accretive growth situations. Obviously, values are pretty rich today, but I think you always have to be looking because you have the dry powder to act when you think it's going to be long-term value enhancing.
In terms of the dividend, I think amongst the group there's a different approach in terms of the formula, or whether it's special, whether it's something that's more static and sustainable. Is there an approach that you feel has worked the best for you? And presumably that's going to be what you're doing. But how do you think about it relative to what some of your peers are doing? Is maybe the better question. I'm going to start with Ted.
I thought you were going to start with Jeff. Darn. Yeah, we've taken an approach of paying what we call an irregular dividend. We say it over and over again. VLGC rates are irregular, therefore our dividend policy is going to be too. Look, it's judging by our total shareholder returns. It's worked out well. We like it from. It gives our board ultimate flexibility. We're very clear with investors, and we found overall it's turned out that most of our irregular dividends have been the same number, $1 a share, and we've sort of found that seems to be easy for investors to price in, as opposed to trying to figure out what our EPS might be and what some percentage payout's going to be. So we're happy with it. Could we change it? Yes, that's the beauty of it.
Jeff, you're natural to follow Ted.
Oh, sure. So. I'm not a very original guy. I just borrow things, good ideas from other people, and you had the irregular sort of taken, Ted. You started using that before. So, no. But our serious answer is that we had a regular, sustainable, long-term. We do have a dividend that will, knock wood, never go away. We saw that we're in a prolonged upcycle. We declared a dividend that we probably called special the first time. But then we were looking at the second or third quarter doing it, say, if it's every quarter, it's not really special, right? So I was watching CNBC one day, and I saw a CEO of a commodity company in a different sector say that they were paying their supplemental dividend. It was Weyerhaeuser. They have these cycles where they make a lot, and then they don't for a while. I said, that sounds like a great idea in terms of labeling. So we went with that, and so we pay a regular dividend that is fixed, and then based on where we are in the cycle, which has been good for 2 years in tankers, as we all know, the management recommends the board, and the board puts out a number, which is not a formula. We've resisted that, but maybe it's all about semantics, though. It's not a rigid, like tying our hands to one number, but we have gradually provided information to the market. I'm not sure if I use the word guidance or not, but it was 50% of net income for a while. I didn't like that. Didn't like using net income because net income's not cash. But as Lois and I always talk about, you can't lecture the market. The market wants what it wants. It wants a reference point to net income. So then we moved it up, and most recently we paid 75% of net income. So I think the market knows, and it's like with Ted's irregular regular, they're going to get $1, probably. It's not a locked thing, but if history's a judge, if you're making some money, you're going to give out $1. For us, you're going to get probably 75% of net income. So if you look up next year, and anyone can look up on FactSet, Yahoo Finance, Bloomberg, even if you don't have a terminal, go to Yahoo Finance, and you'll say $8 for next year. Okay, I'm probably going to get $6 of dividend if I own Seaways. Pretty simple. So that's where we've gone.
Chris, maybe you guys have bought back some stock. Can you talk through sort of your views on sort of how you approach the dividend versus the buybacks?
Yeah, we bought back some stock. Yeah.
You could say.
We have this same philosophy. A sustainable dividend is important. We think we want to give some level of certainty through all cycles of the market, and that's where we start, and that's where our dividend is at. Next is the buybacks, and the buybacks we love the buybacks because we're opportunistic about them, and we can take advantage of pricing in the stock market to buy back what essentially are product tankers at a discounted price, and that's why we've aggressively pursued that strategy. That strategy, we believe has worked out well for us. It's been supported by our shareholders all year. So, that's sort of the long-term thinking. And, once you reach a point where the stock price, is I don't want to use the word expensive, but fully valued, then you make other capital allocation decisions at that point, and investing in fleet, increasing dividends. But, this year we've returned $350 million to shareholders, $7 a share in the form of dividends and stock buybacks, and that's been pretty well received by our shareholder base.
So with that theme in mind, and this might be a bit provocative, but Bart, maybe I'll start with you. But generally speaking, not specific to anyone here, but just generally speaking, I think that many shipping companies are sort of trading at discounts to NAV. If that's the barometer for value, it's of course one barometer, but to me that's clear that maybe the returning capital to shareholders is underappreciated. Do you have any views on perhaps why that may be?
I think certainly the last few weeks, we've seen tremendous volatility in our freight markets, in the equity markets, and really feel that when you have these kind of headline risk, it's I was just talking to John Chappell before coming in here, and he was just pointing out that it's more about reasons to sell than anything else, and I think you have to look beyond that, and in terms of how you're allocating capital, how you're building value, and positioning yourself through the cycle, and one that yes, you've got tools in the short term, and in terms of dividend level buybacks, further investing in your fleet, but I think that looking beyond that, and it was with our team in Houston earlier this week, and I think as an industry, we probably have used the wrong nomenclature where we've been talking about summer seasonality, but it's actually seasonality that usually plays out when you start to hit near Thanksgiving. And certainly seeing the freight markets actually have a potential point of inflection this week, hopeful that we start to see strong fixtures, and you get more visibility of solid cash flow in the back half of Q4 and into the winter season.
I want to pivot a little bit to the balance sheet. In terms of, if my math checks, I think amongst this group here, you've got north of $2 billion of liquidity. cash plus revolvers. Hypothetical question, and I want to just walk down the line, but if I told you you had double your cash balance, but you had to spend the increase to get back to where you are today, how would you spend it? Chris?
Buy back stock. We've answered that question this year. We'd probably deploy it that way. Other than that, we would be patient. As everybody up here has said, asset prices are pretty high right now. And so we've been sellers in the market, but we would be patient. We love transactions. We love looking for positive NPV projects. But they might not be here today, but we might be waiting for that opportunity to come up. And so it would more be of a patience game and seeing how things play out.
Are we all buying back stock?
Yeah, I think Chris answered for me anyway.
Yeah, and I think at the same time too, like the discipline, whether it's a multiple that's twofold or something else, like you have to come back to your principles and how you're allocating capital, and think about, okay, you still have your multiple levers. You might adjust, but the theory should hold. Yeah,
I would just add. I think across all shipping sectors, asset values are firm. You couldn't get a new building until 28, so that doesn't seem like a great use of capital right now. If asset values suddenly dropped, I would probably a lot of us, but we would certainly look at buying modern secondhand tonnage that kind of met our thresholds for fleet efficiency and bells and whistles, as I call the stuff that technical people do.
Yeah, go ahead.
Yeah, no, I was going to say, so Genco, we're a dry bulk pure play. We operate Cape and Ultramaxes. If we obviously had double our cash balance or liquidity position, I would invest in modern Cape-sized vessels. That's been the best performing sector in the dry bulk space over the last 12 to 18 months from an asset value appreciation perspective as well as a freight rate perspective. But when you look ahead, the supply side situation is by far the best within the dry bulk space, 7% order book. And then when you have the demand growth drivers, more iron ore out of Brazil and more iron ore from West Africa, you have a supply constrained environment going into next year, and then you also have the long ton mile situation. So it really sets up pretty well for that sector.
The reason I had a hard time thinking about that question, and you were nice enough to prep us for it, is that I have this, even though we all know cash is fungible, and if it's a bill, it's green in our country, and if it's on our accounts, it's just because cash are short-term investments. But it's different, right? For me, we're operating a bunch of steel and trying to turn it into cash, and then take that cash and turn it into more steel and more cash. The cash that comes from selling vessels, that's like, maybe you call that blue cash, right? That's not available, in my mind, for giving out somewhere else, right? That's going to go back. The blue cash goes back into vessels. Free cash flow from operating the ships, and I always say I have the easiest job in the world because Lois, who you heard before, and her whole team, they do the revenue and the EBITDA and the free cash flow, and I have to do none of that, right? I just get to think about what to do with it when they make it, right? So with free cash flow that we make, that's where the fun begins, and what are we going to do with that? And we've all been talking about it, and the most important thing you've heard, the serious comment, is no one's talking about one thing or another. You're trying to get a little debate about buybacks or dividends, but everyone here is saying it's a balance. And that's really the most important thing. The message is that if you're going to invest in a company, make sure the CFO and the CEO are in alignment talking about balance. But I would say, having said that, and for Joe, this is off the record. If you you gave me double my cash, so that's $150 million bucks, and you didn't tell me whether it was blue cash from selling ships or red cash from free cash flow, I'd probably buy shares of another shipping company. What the hell? It's been done. So which one?
Interesting.
Well, it could go to Scorpio. But they don't pay much of a dividend. They're just doing share repurchase. I don't. So and Bart, you guys are doing a great job, but the dividend is not as high as I'm used to. So I think I'm going to either go with Genco or Ted's irreg. Split it in half between Genco and LPG and get a good dividend.
So you're not going to be a pure play then, right?
No, but I think
who's saying that makes you not a pure play? I think Scorpio's a pure play tanker company.
No, but I think
have some investments.
But you're right. I mean, that is that's one of the problems with the buyback. And again, we've bought back too, so I'm not taking. I don't have a different view, but it is a one-way trade. You can put it on, you can't take it off. And so we have speculated in the shares of other companies and our peers because we can buy and sell those. We can only buy our stock. We can't turn around and resell it if we think the price has reached an acceptable level. So to Jeff's point, that's not a bad thing. And I'd also, underscore Jeff as usual because he's really smart. I mean, he went to Yale, he went to Columbia Law School, and he's really smart.
You almost got in there.
No, not even. That's nice of you to say, though. But in any event, it is. You're right. I mean, there's a fallacy, right, of effectively paying out depreciation, right? I think we saw that sometimes in the last cycle. That cash does have to be around for reinvestment. Totally agree with that. And again, it all comes back to managing the cash, managing investor expectations, because we all want to invest countercyclically. We won't get it right all the time, but that's what we're supposed to do. So, I think, and that's the challenge, right? I mean, if you gave us all a pile of money right now, looking at asset values, looking at all the alternatives, you got a similar answer, and that's not surprising. But if you ask that question in 2018, you get a very different answer.
I think you generally work, when it comes to the banks, I think you generally work with similar banks. Peter, maybe starting with you, I mean, what have you seen in terms of the development of the bank market from a lending perspective? Big changes to structures, different banks calling on you. How has that developed over the past few years?
Yeah, no, it was interesting. We did a deal in August of 2021. Terrific facility, term loan, revolver, split 75-25, and then D&B actually in end of 2022, a year later, basically was saying your revolver's not big enough, and then we were like, was that a joke? Is that serious? Because we had just done a deal, but then you start to go through the evaluation process during 2023. And you start to realize, okay, we're getting to the point where we're going to be paying down term loan debt. We're actually going to be hurting the company by voluntarily paying down debt and losing that borrowing capacity. So what we've seen from the banks is more of an ability to be more flexible with owners and tailor things to our capital allocation strategy, putting in more revolver debt. We did a $500 million full 100% revolver structure in November of last year. And it's tailored exactly to what we want as a company. And we also reduced the margin too. So flexibility, more revolver capacity for owners that are making quite a bit of money in these levels, and then also lower margins.
Bart, you don't have a whole lot of debt. How has that impacted you in terms of the banks?
Yeah, no, I mean, so similarly, now we're at a state where we have 100% revolving capacity. And I think it's important that you match your sources of financing with where you are in a cycle and preserving the optionality. And so for us, it's important to maintain that relationship with your banks. And so structurally having the revolving capacity, I think quite important, but at the same time, it has to be that strategic match. So, we're getting, often marketed for example, like Oslo bond or other things, but you actually,
we're going to get to that.
There has to be a use, right? And so for us, we still cast a much wider net and maintain relationships across a much wider bank group. But yeah, 100% revolving capacity is giving us flexibility.
Chris, you guys have unwound a pretty substantial amount of leasing debt. Are there any sort of major lessons learned in terms of putting that debt in place when it's necessary, when it comes to better times now?
I mean, the leases had such an important role to play at the time. It was the trough of the market. They injected really necessary liquidity to the company when we needed it. But they're restrictive in their nature. I always make the joke, it's actually nice to own our own assets. And so, they were expensive, and I wouldn't say hard, but tricky to get out of. And so, it wasn't what we at Scorpio preferred as part of our debt structure. Secured lending is more flexible, lower margin, lower leverage. So that's our preference. The leases have a role to play at certain points in time, but at this point in the cycle, we prefer otherwise.
Can I jump in there?
Please do.
We did some sale-leasebacks that were also in a time where it was the worst year ever, like Lois was talking about earlier, But and having the highest amount of leverage was worth a little more margin and a little bit of less flexibility. And we paid off all those too, except for the one that isn't flexible enough for us to pay it off yet, but we probably will. But it's changed. I think right now, I don't know if you're getting to this, Andrew, but the lease product out of China now is not so much about that. They're outbanking the banks, or they're trying to outbank your commercial banking colleagues. I know it's not you, Andrew, but it's not about high loan to value. It's just a competitively priced in terms of tenor, profile, margin, et cetera, and as more flexible than they were in the past. So I think it is that we have to look at diversification of our balance sheet as a smart thing to do as CFOs. That no matter how good D&B might put together a product for us or some of the other Scandi European banks, we don't want to have all of our eggs in that basket. You have to look to Asia where, that's where the money is. So I think having some diversification into Asian leasing, whether it's Chinese, Japanese, or whatever, is smart.
Ted, not too many people have tapped the equity markets. Can you talk about that as a tool in the toolbox and how that sort of played out for Dorian?
Yeah, I mean, I think it goes with, I think everybody's goal to finance and invest countercyclically. And, from our perspective, we had been watching our stock price and knew that we were in a position where that was actually, theoretically available to us. We were trading at a multiple of NAV. We spent a lot of time debating first, do we really need to do this? And then once we decided that, well, how would we do it? Spent a lot of time thinking about doing convertible debt versus straight equity. And, for a variety of reasons, we settled on straight equity. And then it was just a matter of finding the right window, and we did in the summer. And I think it's one of the benefits of going through some of the torture that is involved in being a U.S. public company. I mean, but we were able to basically, courtesy of our lawyers not sleeping very much, but really go from a standing start to a fully marketed equity deal in, I don't know, 7 days. That was really good, and investment banks all did a great job. But being ready to pull the trigger. I mean, that's rule number one of capital markets, right? Well, rule number one is raise money when you can, not when you need it, and rule number two is be ready, in my opinion. And so, we were well positioned with both of those, and happy with the outcome.
I want to talk a bit around sort of how you guys are investing in the existing fleet, or on the new build side. But Bart, I think Ardmore has done some interesting things, particularly around the sort of technology side. Can you give us your views on sort of how you measure potential returns when you take those types of investment decisions?
Sure. I mean, it really comes down to the alignment of reducing fuel consumption, which reduces emissions, and drops to the bottom line. I think really, though, taking a step back for a moment, so Ardmore set up an energy transition plan team in 2021, and we really had to take the approach that an engineer in general wants to find the perfect solution. Until it's at that state, they're not usually willing to experiment. And with the pace of change, you needed to actually really be looking at a range of technologies, software, hardware, the combination of them, and get to a pilot point much quicker than I think you have in the past. We took the approach where we took some engineering expertise and took them away from their day job, which really they're measured on OpEx performance and crewing, and then it usually comes every 5 years and say, hit your dry dock CapEx budget, and by the way, what else can you do for the vessel to make it more efficient? And it was like, no, make that a systematic approach. And so constantly looking at potential investments, incremental investments in the vessels. We've looked at like 250 different technologies, and we end up deploying only about 10% of them, but we actually view that as a win, but definitely a mind shift. And these are short paybacks, 1-2 years often, and IRRs, 40 to 100% plus. So really easy investment decisions.
Got a minute left. You guys are doing some different things. A few of you have new builds. A couple are kind of doing more secondary. Can we just quickly round out with regards to sort of asset values and sort of where you see those going in the next year if you had a crystal ball in your segment? Starting with Chris.
It's hard to tell. I mean, right now, asset values the tanker market's come under pressure in Q4. We're still constructive on the outlook. We see a well-balanced market going forward. the geopolitics has inserted a lot of volatility into the markets, and I think it'll continue to do so, and that'll affect asset values. And I think next year is not going to be any exception to that.
Ted?
Yeah, I'd say, look, similarly constructive. We like the long-term trends in the business, and the near-term order book's manageable. So there's no obvious driver to see either a massive increase or a massive decrease in values.
Bart?
Yeah, I think similar to Chris, you've got this volatility today. There's a number of vessels that are being circulated, but you're not seeing, a match in terms of bid-ask spread. And I think you're waiting to see, how the seasonality shapes up and what that means for Q1 and the start next year.
Peter, you like capes?
Yeah, look, capes are they're obviously a big China play, but certainly really good supply-side fundamentals. When we look at asset values, new buildings have played a huge role in terms of the secondhand values. The yards are full. You can get 28 delivery. Invest in the ships today to get earnings today to de-risk those investments right away. So we don't really see a big pullback in terms of asset values, despite being in the third or fourth quartile. But it is overall, it's a really good supply-side picture, which you don't really need much demand growth to outstrip that supply growth.
Yeah. Jeff, final word?
I know we're going over, but in tankers, I think it's fashionable now to wring your hands about, oh my God, our values, rates have been a little soft, China's gone. Next thing you know, values are going down. Well, look, it should be no surprise for a little softness in older tanker vessels. The world built a new fleet of 500 terrible sanctioned vessels for Russian trade. We'd never sell to that. None of these companies would. But when there's that buying pressure out there, you think maybe it helps the asset values a little bit. And now that job's done, it's not too surprising at some of the older vessels. And nothing's been recycled. We know that. So I think maybe it's a little softness in tankers, not surprising, but we're only halfway through this cycle. So I, like the others, think that we can't wait for a big drop. You're going to assume asset value is going to stay here.
Gentlemen, thank you for your time.
Hey, before we leave, I'm sorry, I'm just grabbing the mic. I promised that Ted I was going to have a special presentation for him. So when we got to the names I told you he stole the best A name for a dividend. So when I was at CVS this morning, I was trying to think which way I'm going to go with this. But Ted, for that irregular dividend, I'm going to give you some Pepto-Bismol. It'll make you feel better.
And I can see, Jeff, I was more boring than you, and thank you very much. I appreciate it.